All right, good evening. My name is Michele Ferrario. I'm the co-founder and CEO of StashAway. Thank you for joining us tonight, and thank you, Stephanie, of course, for being here tonight. Tonight we're going to talk about Q1 returns, and we're going to talk about looking forward. So what's going to happen, or what can happen over the next few months and quarters. And we titled the webinar as "Leveraging the Power of Diversification Amid Uncertainty." If you have been reading the papers or watching the news, you know that there's been quite volatile over the last few weeks. And that's where the power of the diversification actually becomes the most important. The way we're going to organize tonight is that Stephanie will go through a presentation and trying to give you as much detail about the economic situation, about market performance, about the StashAway portfolio performance. And then we're going to have a Q&A session. If you have any questions at any point in time, please use the Q&A button on Zoom, or if you are on YouTube, write your question in the comments. And at the end, I will moderate. I will help Stephanie go through as many questions as possible. Okay, so Stephanie, if you can kind of click to the next slide. For those of you that might not be as familiar with StashAway, we are a digital wealth management platform. We've been around since 2017 in Singapore. We're now live in 5 markets: Singapore, Malaysia, Thailand, Hong Kong, and the UAE. We are licensed in each of these 5 markets. I'm not going to go through the accolades that you can see on the right side of the screen, but we've been recognized quite a few times over the last few years as a kind of up-and-coming wealth manager that has done things differently. And we're backed by blue-chip investors, including Fidelity, including Sequoia, including Hamilton Lane, and others. If you can help me go to the next slide, Stephanie, just a quick summary of what we offer, again, for those of you that might not be as familiar with the platform. So let's start with the core portfolios, which is the foundation for long-term investing. This is where everybody should have 60, 70% of your money, diversified portfolios across asset classes. The most popular, the first product we launched is what we call general investing. We have 2 versions of that, one powered by StashAway's investment framework, and one powered by BlackRock's asset allocation. We have a passive income product powered by JP Morgan, and then we have a flexible portfolio, which allow clients to build their own portfolios or invest in ETFs. It's actually the easiest platform to invest in ETFs in the region. We then have a suite of cash management products. This is currency dependent, so it varies by country. We have a few products in Singapore: Simple, Simple Plus, Simple Guaranteed. In Malaysia and the UAE, we have Simple. And in every country, we also offer a US dollar cash product. We call it US dollar cash yield. We have a few thematic portfolios: technology enablers, consumer tech, healthcare, environment, and Singapore investing, which is live only in Singapore. And then for those of you that are accredited investors in Singapore, or professional investors in Hong Kong, or a professional investor in Dubai as well, or in the UAE as well, we also offer alternatives investment that include private equity, venture capital, angel investing, private credit, and crypto ETFs. And private credit particularly, actually, we launched today on the app. We've been live for a year, but today we actually did quite a few improvement on the app, and and we're very proud of what we actually bring to our clients there. So if you are an accredited investor, a professional investor, do reach out to make sure that you can know more about that. Now, tonight's focus, the first part of the presentation is going to be about returns, and I'm going to be focused on what here are called the expert managed portfolios, so the general investing by StashAway and BlackRock, as well as on the thematics portfolios. And then Stephanie will also kind of talk a little bit about what's happening in the markets, what's happening in the economy, and therefore, our kind of best, what is the best positioning, what you can do to manage your investments going forward. So maybe Stephanie, you can go ahead. I'll leave it to you. As mentioned earlier, maybe let me repeat that. If you have any questions, please use the Q&A button that is at the bottom of your Zoom interface, or if you are on YouTube, write a question in the comments, and our colleagues will make sure that we bring it back to this session. Stephanie, over to you.
All right. Thank you very much, Michele, and everyone, welcome to tonight's webinar. Indeed, it's a very, very interesting time to be having a webinar with you all, and thank you so much for spending your night with us. I'm sure all of you, given that there's a lot of you here, every one of you will have a lot of questions. So we'll spend perhaps the next 20, 30 minutes going through the slides, and we'll try to leave as much time for Q&A as possible to address questions on your mind. So first of all, let's go through the 2025 first quarter portfolio returns, and before we go into the outlook for the next few weeks, if not like for the rest of the quarter. Here is a slide that summarizes kind of how statutory portfolios have done in the first quarter of 2025. So happy to sort of report that despite all the macro uncertainties going on, all the general investing portfolios powered by Stashaway has actually posted positive returns. This is across all risk levels. So from the lowest risk SRI 6.5 to the highest risk SRI 36, they return positively. These portfolios on average returned 2.4% in the first quarter. The lowest return was 0.8% on the lower risk side, and on the high risk side, and 3.1% on the lower risk side. This actually compares quite favorably with the average benchmark returns of 1.8%. So on average, our portfolios have actually outperformed benchmarks by about 50 to 60 basis points. Third point that we like to just sort of, I guess, show, and you see in the latest slide as well, is that in the first quarter, global equities have been kind of choppy, but still, like diversification actually paid off, especially with gold and ultra short duration bonds. In the first quarter, those helped to protect against interest rates and geopolitical risks that we've seen in the first quarter. We also have some charts on the BlackRock portfolios. They corrected somewhat in the first quarter, but have maintained positive returns over a longer kind of 12-month horizon. Similarly, for thematic portfolios, we saw some downturns in the tech-focused portfolios in Q1. However, the more defensive thematic portfolios, for example, healthcare, actually remain quite defensive. So here is the, I guess, here's a chart that shows you the returns for different asset classes in the first quarter. So you can see there are four different colored lines, and the one on the top, which returned 18.2%, is actually gold. And needless to say, it has actually gone on and returned even further in April. Now, on the bottom, you see three lines. The lowest kind of darker blue line, that's minus 1%, that's global equities. And that's kind of lagging the pack in Q1. And I mean, as we all know, it faced further pressure in April. In the middle, you see actually ultra short dated US Treasuries returning 1%. I mean, these are kind of your cash equivalents. And at Stashaway, we actually invest in a ultra short dated US Treasury ETF, which provides very, very stable return. And in the first quarter, actually, global bonds returned slightly better than that's just holding cash management. So global bonds actually returned 2.6%. I think the message here is also that referring back to my point about diversification, actually, you can see that in a quarter where both bonds and equities did not return fantastically, actually, gold provided a very good kind of defensive quality and also provided diversification benefits. Now, of course, it's not just on the asset class level, but if you look at kind of within equities or within bonds, I mean, there are pockets that are stronger. So, for example, if you look kind of within global equities, geographies like China, geographies like Europe actually provided actually better returns than the US. So again, within kind of these asset classes, there are divergent performance as well. As some of you may know, at Stashaway, our portfolios all have certain allocations to gold. And this is actually by design. Since last year, we've actually included gold in our strategic benchmark. So if you look at this table, it shows you clearly what are the strategic allocations for different risk points. Now, allow me to explain a little bit what I mean by strategic allocations. So these are basically the if you think about the Stashaway managed portfolios, there are four basic building blocks in terms of asset classes. So these four building blocks are global equities, global bonds, ultra short treasuries, and gold. And when we use these building blocks, we build them in different kind of proportion of different sizes according to the riskiness or the kind of the Stashaway risk index of the portfolio. On the left-hand side, you can see that we start from SRI 6.5, which is our lowest risk kind of Stashaway year-end portfolio. And 6.5 have actually a lot of allocation to global bonds, 54%, quite a bit of allocation to ultra short treasuries, 40%, some equities and some gold. So on the right-hand side, you can see that for the high risk portfolio SRI 36, we have 92% allocated to equities and 8% allocated to gold on a strategic basis. So these are on average over time our kind of benchmark or our average allocation. Now, if you compare this with the traditional kind of no gold, no ultra short treasury portfolio, which is generally referred to as a 60-40, these portfolios mostly only have equities and bonds. So at Stashaway, I mean, because we believe in the power of diversification, we've actually added more asset classes to our portfolios. And these are the benchmark weights. However, what we do in addition to having these benchmark weights is that we also use our economic regime asset allocation framework, ERA, who a lot of you may be familiar with, to tilt these allocations slightly according to the regime. So for example, if we are in a recessionary regime, then most of the portfolios would see more allocations to defensive assets, which means that they could see lower allocation to global equities compared to what I show here in the benchmark. So I think the benefits of having more asset classes, more diversification, is number one, you would be able to potentially generate better returns from these diversification kind of different types of investments. But also more importantly, I mean, during periods of stress, which we've seen in the first quarter, this diversification actually helps to cushion some of the downside of risky assets like equity. So in the first quarter, as I've shown in the previous chart, I mean, clearly the defensive asset for gold has helped a lot of the Stashaway portfolios to perform way better than traditional equities and bond only portfolio. I mean, and also we've done a lot of back testing, a lot of just kind of, I guess, quantitative analysis to see, I mean, what is the benefit of including gold in the portfolios. We use something called the Sharpe ratio. So this Sharpe ratio basically is the risk-adjusted return for a portfolio. As you can see here, again, adding gold to all the different risk points. Here we show SRI 36, 22, and 6.5 actually adds to risk-adjusted return, result in a higher risk-adjusted return across risk points compared to just a pure equity and bond portfolio. So this is also one of the reasons why we have included gold in our benchmark allocation since last year. So what happened in the first quarter for Stashaway portfolios? Here is the, I mentioned about the return figures. Here are kind of a more kind of granular breakdown by different currencies and also kind of compared to the benchmark. If you look at the chart on the left, you can see that on average, general investing portfolios in US dollar have returned 2.4%. Compared to average benchmark of 1.8%, there's a relative performance of 50 to 60 basis points. Similarly, we also outperform in other currencies. Now, of course, the difference here between the different currencies is the underlying currency movement of Singapore dollar, Malaysian ringgit, and Thai baht versus US dollar. However, one thing I want to point out is that even though our portfolios are actually denominated or priced in US dollar, because we actually invest in global assets, global bonds, global equities, and also gold, actually the underlying exposure is not 100% US dollar. Indeed, if you look at kind of the allocations, the US dollar allocation itself, it's only about 50% of the portfolio. So we get a lot of questions about, oh, I mean, should I be concerned about my statutory portfolio because it's in US dollar and I see US dollar falling? Even though you see it's in US dollar, the underlying is actually not entirely US dollar. So again, here, the reason why we don't have 100% US dollar exposure is because we want to enjoy the benefit of diversification. On the right-hand side, this actually plots the time series of the three SRI portfolios over time during the first quarter, actually up till April, last Friday. So you can see that there's a much more stable line, which is a blue line. The blue line is actually our 6.5 lowest risk SRI portfolio, which has been very, very stable. So the reason why we have these different risk points, and also the reason why we have the SRI, is because we want to help investors to decide what kind of risk you want to take. Now, of course, over the long term, the higher risk you take, the better return you get. However, as we see in first quarter returns, actually from time to time, because the equity market actually corrects, the higher the SRI level, the more kind of dip you may see in terms of mark to market. And as you can see here on this chart, SRI 22 have actually a bigger drawdown than 6.5, and 36 had a bigger drawdown than 22. So this is sort of in line with expectations. However, if you compare the 36 or 22 with, like, these are portfolios that are higher risk, or for SRI 22 is medium risk, SRI 36 is higher risk. If you compare these drawdowns with just US equities, for example, or even just the equity index, these drawdowns are a lot more controlled. So US equities, for example, have corrected 20% from peak. If I look at SRI 36, it has corrected about 12% from peak. So a little bit more than sort of half of the US equity correction. And that's because it has allocation to gold and also non-US equities. Again, showing the power of diversification. And actually, if you look at the April year-to-date returns, most of our portfolios are actually in positive territory, except for SRI 36 and I think 32. So this again shows you the resilience across our different risk points. And I guess here you can see the different, again, this is a table that shows you in detail how our different portfolios have performed in the first quarter. I think I won't go into details here, but on the bottom you can see that again, it's on average we returned 2.4% in the first quarter. And over the trailing 12 months, on average, general investing by statutory portfolios have returned 7.3% compared with the benchmark, which is 6.4, resulting in outperformance of 90 basis points. So I guess we show the numbers up till March, and a lot of you would be kind of concerned because Liberation Day was on April 2nd, and since Liberation Day, the market has actually gone quite volatile. And here's a more detailed table that shows you how our portfolios have done year to date, and also in the past month or 3 months. These numbers are actually updated until the until last Friday. So these are quite updated numbers. And I guess the focus here is on the column here on the left, which shows you our relative returns versus our own benchmarks. So these are benchmarks including gold. So for example, if you look at kind of the lower risk side, we're roughly in line with benchmarks. On the high risk side, we're actually beating our own gold included benchmarks. Similarly in the medium risk side as well. So this shows you that, the tilt that we have currently, which is inflationary growth, is actually performing better than our kind of non-tilted weights. Now, more interestingly, I guess on the right-hand side, you can also see a comparison versus the traditional no gold, no ultra short treasury benchmark. And here, I think, so what we can see here is on the lower risk side, we are underperforming the benchmark because we have more kind of I guess we have more we have a bit more equity compared to the no equity sort of the lowest risk benchmarks. However, on the high risk side, we are significantly outperforming both on the 22 and 36 SRIs because of the allocations to gold, and also because of the tilt that we take in the different kind of equity sectors. So, for example, we have allocations into sort of, I guess, industrials and defensive sectors that are kind of outperforming the market. So, I mean, that results in a relative outperformance of 2 to 3, actually close to 3% year to date versus a traditional benchmark. Here is another view of how to think about the returns of the different SRI portfolios. I mean, this chart basically shows you all the ETFs that we have in the different portfolios. And I guess, as you can see here, it's quite a lot of different ETFs that we put into the different portfolios, particularly for the middle risk ones, because we need to have a mix of bonds, equities, gold, everything, right? So the green bars, like the green rows, are things that have contributed positively to our returns. On the lower, I guess on the lower side, on the bottom, you can see that there are like these red rows, and these are kind of detractors from the portfolio. As you can see here, I mean, most of the allocations actually have contributed positively to our return. And again, it may be a bit too hard to see, but on the bottom, the biggest drag is actually coming from technology. And this shows you that diversification, again, has helped our portfolios. So moving on to other portfolios, here's a chart that shows BlackRock portfolio performance. On average, BlackRock portfolios have given back some of the gains in the last 12 months. However, still returned quite decently. So the average return was 5.8% in the last 12 months. Thematic portfolios have suffered some more downturn in the first quarter due to particularly those that are exposed to tech. So, for example, technology enabler and future consumer tech both were negative. However, I mean, these are also thematics that have performed much better in the last 12 months. So just giving back some of the gains that it had. So in the first quarter of 2025, healthcare innovation actually was the more defensive thematic portfolio, returning on average 0.7%. Moving on to our kind of more localized portfolios. So on the left-hand side, we can see the numbers for the Singapore portfolios, and on the right-hand side is our Malaysia DRB portfolios. So let me just go through them quickly. On the left-hand side, you can see that our Singapore investing portfolio had a decent first quarter. So in the first quarter of 2025, it returned 2.4%. And on the trailing 12-month basis, actually Singapore investing in returned 9.5%. So it's relatively quite resilient as well in the first quarter. The second portfolio is a Singapore income that we partnered with JP Morgan, and we launched that in July 2024. So up till March 2025, the portfolio have achieved 5.2% in annualized return. So again, providing a good kind of source of income. Lastly, Singapore cash management. We have two cash management kind of products here. Simple return 3.1% in annualized terms, and Simple Plus return 4.3% in annualized terms. Moving on to DRB, on the right-hand side, you can see the portfolio's returns for first quarter as well, trailing 12 months. Here, the high risk portfolios also suffered from the equity drawback. So DRB portfolios on average have returned negative 0.6% in the first quarter and minus 1.8% in the trailing 12-month basis. So we've gone through the Q1 portfolio returns relatively quickly, and I guess moving on to the more interesting part, which is like the state of play that we see currently and how you can position your portfolios for this very, very volatile period. So I think all of us have been I guess watching the news and also been seeing kind of like headlines every day coming out talk about what Trump said or what Trump did. And I think a good reminder is to revisit what Trump did in 2018. And back then, also, I mean, that was Trump's first term, and one of the kind of, I guess, the hallmark policies that he was trying to push was also tariff. So, if we kind of summarize what the Trump kind of negotiating strategy is, I borrowed this chart from BCA Research, which actually puts it quite nicely. So, these are the 7 steps that Trump has employed to try to, I guess, reach a deal. First step is to ask for the moon, and second step, whip out your big button, basically, and then third step, punch somebody in the mouth. So I think actually all three of them sort of happened on Liberation Day, and of course Trump came in with a kind of a baseline 10% tariff, but also a list of other kind of additional tariffs that he calls reciprocal. That actually brought a lot of chaos to the market, and I mean I think now we're sort of in phase 4, 5, and 6, which is a kind of lengthy phase of negotiation. Now, as you all have seen in the news, I mean there are I think 70 to 90 bilateral agreements that have to be made, and Trump and Besant's team are very busy talking to each one of them. And I think their hope is that by the end of this quarter, they will be able to make progress with all these trading partners. Of course, the difficulty is that number one, it seems like I mean since Liberation Day, we haven't seen a lot of progress. And number two, also if you kind of look at this Trump playbook, number 5 is like what Trump likes to pull out last minute, right? So right when they were about to strike a deal, I mean Trump likes to sort of pull a trigger and try to kind of disrupt and get maximum pressure. And then step 6 is that okay, I've tried and works doesn't work. However, let's just sit down and make friends. I think this is also sort of playing out with China. So what does this mean, right? This means that the news flow is going to be very confusing, and it's going to change from day to day, and it's impossible to predict. I mean, what the next move is. However, what is kind of I think comforting is that if you look at this 7 steps, the last step is make a deal. And I think there is a timeline to make a deal, which is end of second quarter. Because why? Because by the end of second quarter or by third quarter, actually, there's a lot of other policies that Trump and Besant and the team needs to push out. For example, the tax cut bills, deregulation, et cetera, et cetera. So they need to kind of get this trade tariff out of the door first before they focus on the kind of the more growth focused policies. And the reason why I say there's a timeline is because next year there will be a midterm election, and of course, I mean Trump needs to win that midterm election. So if he doesn't follow this timeline, I think he risks pushing the U.S. economy really into recession, and that risk losing a lot of seats at the midterm. So I say hopefully by 3Q we will have a deal. And that's exactly what played out in 2018. And I mean, it's not too long ago, but I mean, given that a lot of things have happened in these few years, including COVID, of course, I think maybe a lot of us have forgotten like what happened back then already. And this chart basically shows you the S&P 500 during the fourth quarter of 2018 and the first quarter of 2019. The first thing that you should note is that there was a drawdown. And if you look at the black line, it went from, it actually had a 20% drawdown. And I remember actually the bottom was actually on Christmas Eve, like 24th December. And if you look at the right-hand side, recovery phase, it also took about 3 months to recover everything. So if you just kind of shut your eyes, don't listen to the news, don't watch TV, actually nothing has happened in the 6 months. However, of course, a lot of things happened because it was Trump basically trying to make a deal, not make a deal, et cetera, et cetera. I think the lesson here is that, yes, I mean, the market would be volatile during this period, but if we kind of, I think if we follow the playbook of Trump, then eventually, the market will recover. Now, of course, hopefully it follows the playbook. It's also 20% correction. It's also a 3-month kind of correction phase. But I guess essentially what we do is that we don't predict, we don't hope, we look at the data. So we'll see how it goes as the data shows us. The other reason why I think Trump is under pressure to deliver and also not to kind of let this drag on for too long is, of course, I think there's 2 bottom lines that got touched in the past 2 weeks or so. The first one is if you look at Trump's approval rating, and this is a chart that's done by YouGov, you can see 2 lines, and I guess the red line on the top is basically like people who disfavor, who says I don't approve Trump, and on the bottom purple line is that I like what I see like Trump is doing. And I think over the past 2 weeks or so, the disapproval rating of Trump has actually gone up quite dramatically. And as we all know, even though Trump says he doesn't watch the S&P, he watches these polls like a hawk. So I think this is one of the reasons why he has softened his stance on China or on tariffs, for example, quite recently. The next kind of red flag is the bond market. Now, even though Trump says he doesn't watch the S&P, he does watch very, very closely the US bond market. And there is a good reason why. The US actually needs to refinance a lot of debt this year. So it is one of Besant's mandate to actually get bond yields down in order to refinance all these debt in the coming months. The second reason is, of course, even with Doge, the US government will have a lot of fiscal deficit, and they will need to borrow a lot of money to kind of fund that fiscal deficit. So if they don't get the bond market under control, it means that it will be very, very expensive for US to borrow this money for Trump to spend. So, obviously he cares a lot about bond yields. This is a chart that shows you the 10-year Treasury bond yields. And you can see that basically I drew a line here with 4.5. And I think 4.5 is actually a level that gets the Trump team quite nervous. Why? Because I guess if you look here, 4.5 basically has been the peak for the last sort of 2 years or so. Now, of course, there were some periods when the bond market was trying to test 5, but I think that like they don't want to kind of get too close to that like very, very red line. And indeed, on the day when bond market touched 4.5, that's when Trump actually made a U-turn and softened his stance. So if you want to do a prediction of like what Trump's policy are, watch the 10-year bond yields. And going back to the equity market, which we all love to talk about and care a lot about, I guess I do think that perhaps the most stressful period was behind. And this is a chart that shows you the VIX index. And the VIX index is basically a measure of the stress in equity market. It measures the volatility of the daily moves. So, i.e., how much a stock market moves on a daily basis. Now, of course, when the market is in a bull market, it doesn't have sudden moves. However, during a bear market or during these panic periods, typically that's when you see volatility spikes, right? You see a big move in a single day. And both on the way down, on the way up as well. So you can see here, there were certain like different periods when the VIX actually spiked up quite significantly. On the left-hand side, of course, the top ones are global financial crisis back in 2008 and COVID pandemic in 2020. And if you look at on the right-hand side, that's Liberation Day. And it actually ranks quite high in terms of stress. However, of course, it's not as stressful as COVID or the GFC. And we think that a lot of that is driven by positioning because pre-Liberation Day or pre-kind of Trump inauguration, a lot of people are actually crowded in the Max 7 in US tech stocks. And a lot of that has to do with rotation out of these tech stocks. Now, the next question to ask, and a lot of people are concerned, is that are we going to see a US recession? So again, going back to data, because I think when you read the headline, you see, oh, JP Morgan is raising its recession probability forecast to 60%, etc. However, it only represents one view. So I mean, what we like to do is we like to look at a consensus which takes into account all these different forecasts by the different economists. And this is a chart that shows you the 1 year forward recession probability that is pulled by Bloomberg. You can see that on the right, that probability now sits at 30%. So what it's saying is that according to the panel of economists, they think that for the next year, for the next 12 months, there is a 30% chance that US will go into recession. Now, it's 30% high or low. A good reference is the historical kind of time series. So as you can see here, actually, we've been through a much higher kind of stress periods in the past few years. So of course, during COVID, because we did enter a recession, so that probability was 100%. However, in sort of late 2022, the probability also rose to almost 70%. Now, of course, that was because the Fed was hiking interest rates and there were a lot of concerns about slowdown. Eventually, I mean, the US economy was strong enough, and despite the aggressive increase in interest rates, we did not see a recession. So compared to these two more stressful periods, 30% is actually quite manageable. And indeed, I mean, it's still below the historical average. So the historical average is slightly above 30%. So I would say that from a holistic basis, on whole, these economists are actually not too concerned about a US recession. And I mean, of course, those are economists, so they don't participate in markets. So what is the market telling us? The market is basically, so to kind of gauge whether the market is expecting a recession, a very good kind of way to look at it is to look at interest rate markets, because I mean, these interest rate investors actually trade all day the number of Fed cuts that they expect in the next 12 months. So today, if you look at the right-hand side, the market, the interest rate market, is actually expecting the first cut to happen, or the Fed to resume its Fed cut in the June meeting. So and that the cut that they're expecting is about 25 basis points, so one cut. And to me, that is not a signal for a imminent recession, because if you think back a few months ago, when the Fed actually did a first cut, it did a 50 basis point cut. And it did it very, very swiftly. Today, the market is saying, okay, not only is the Fed not going to cut in May, but even in June, it's going to only cut 25 basis points. So I think, again, there's no panic in the interest rate market. And then thirdly, if we look at how the interest rate market actually fluctuates. So we all know the equity market investors are actually quite moody, right? Like things actually swing around quite a lot. Actually, for fixed income investors, for interest rate investors, their moods actually swings a lot as well. And this is a chart that shows you the price of a Fed funds 30-day bond, which means that, I mean, this is the instrument that investors use to bet how much the Fed is going to cut. As you can see here, in the last 2 years or so, actually, the interest rate investors have fluctuated between different levels of cuts, like 25 basis points, no cuts, 50 basis points, etc. So for that, even for the interest rate investors, if you look at their prediction, is not always correct, and it also fluctuates according to their sentiment. So the point here is that I think if you look at where interest rate markets are pricing in terms of rate cuts, or i.e. in terms of whether they fear recession more or not, right now is sort of in the middle of the range that they've been in the last 2 years. So again, I'm not too overly concerned. And also predicting recession is extremely hard in this kind of environment where it's so policy driven and the policy changes every day. This is a fun clip. I took it from Goldman. which is, of course, where I used to work. But if you look at here, basically, over the period of 73 minutes, they have changed their stance on a recession. And that's because Trump just made a new announcement. So again, it's because of the headline kind of driven situation is extremely hard to predict. So what do we do, right? At such way, we just continue to do what we've been doing all the time, which is to monitor the data. Now, the data, if we look at the soft data, is starting to weaken a bit, but the hard data still shows a fairly resilient U.S. economy. However, what I want to show you in this slide here is basically that the longer uncertainty stays, i.e., if we don't conclude all these trade tariff mess in the next 90 days or so, the more likely we're going to see a bigger slowdown in the U.S. economy and also, of course, for the global economy. So what we need to do is basically to monitor the data and act accordingly when we see kind of a more substantial downside risk. So I guess also in terms of the trade tariffs, this is a slide that tries to, I guess, give you a bit of context as to what the team can achieve with all the tariffs. So we know that, I mean, basically the team announced that they will slap on these reciprocal tariffs, and there are some estimates that basically these will result in $2 trillion in terms of additional revenues for the U.S. government over the next 10 years, which means that every year they get additional 200 billion in terms of revenues. However, if you look at the left-hand side, the current fiscal deficit per year is actually 2 trillion. So we're talking about additional 200 billion in terms of revenue out of a 2 trillion deficit. Now, clearly, it's not enough to mend the hole. And in addition, on the right-hand side, you can see that if all these tariffs remain in place, it will have quite a significant impact on GDP growth. So according to estimates, I mean, basically all these tariffs would result in 80 basis points hit to GDP. And this compares to the current consensus of 1.7% GDP growth in the US economy. So the message here is that, I mean, these tariffs are actually not constructive, of course, not constructive for the economy. But even if you consider the revenue impact for US government, is also not that constructive. So net, I think the math basically shows you that it's not worth pursuing. And I think going back to our first slide of all these like kind of tactics that Trump is using, basically he's trying to, I guess, shout first and then sit down and negotiate better. And I think really and realistically, the baseline that they want to achieve is the 10% tariff, which I think would be acceptable by the market and also absorbable by a lot of economies. So given all this, of course, the short-term implication is hard to predict, but I think we've also learned a few things given all these events. And we've actually put out a Seattle Insight. Actually, I think it will be published quite soon on the longer-term implications of all these mess that's going on, because I do think that there are a few things that would be changed. So here, I'd like to, because all of you guys are so nice to spend time with us tonight, I'd like to give you a quick preview of what we're going to put out in the Seattle Insight. So for those of you who have been following our work, you know that in the 2025 Outlook, we basically established it's basically called FAT is the new normal, FAT is the new normal. And the reason why we say FAT is because we think that, I mean, FAT will continue to drive a lot of our investment decisions and also kind of thinking going forward. So what does FAT stand for? F actually stands for fiscal dominance, A stands for artificial intelligence, and T stands for Trump policies. I think artificial intelligence is pretty self-explanatory. Trump policies similar. Fiscal dominance basically is, I think, a move away from the era of monetary policies driving markets to fiscal policy driving markets. Indeed, if you look at the market movements, a lot of that has been driven by fiscal stimulus or fiscal policies. Especially in the first quarter, we've seen actually, for example, Germany announce fiscal expansion. Also, China is increasing its fiscal stimulus, and all these are in response to Trump trade tariffs. And I mean, this is actually one of the longer term implications of the tariff war. And I think also one of the points here on the bottom is that I think out of the past few weeks, what we've observed or what the market has found out is that surprisingly, I mean, equities is actually not the weakest link in the U.S. I guess, fiscal or economy. It's actually the U.S. bond market, because the U.S. bond market sell-off is not normal. Because typically, if the market is worried about recession, equities will go down, but bonds will actually go up. In the past 2 weeks, actually, bonds sold off. So that shows shows you there's a lot of nervousness in the U.S. bond market, and that's because of one of the things that we talked about in our 2025 outlook, which is that, I mean, the U.S. Fiscal deficit is going to keep rising over the next 10 years, and that puts a question as to how much interest rates can be contained. So this actually is, I mean, still a lot of fiscal dominance is playing out in the first quarter. And I think the tariffs actually accelerate fiscal spending by a lot of countries. In the middle is artificial intelligence. Now, I think number one, we had the DeepSeek moment in the first quarter. But number two, given tariffs, we've actually seen who has, I guess, among all the different countries, China has been the most sort of resilient. China has been the most unyielding to Trump's demands. And I think one of the reasons why China has been so firm is because of the DeepSeek moment. And I think after, even if we make a deal, I think China will still accelerate their investments into AI. And also, the other thing that we found out is that actually, when Trump made a U-turn, the biggest U-turn that he's made was to exempt Apple iPhones in the tariffs. So I think actually, if you think about too big to fail, during the great financial crisis, it was the financials. It seems like today's too big to fail is actually Apple and the whole kind of US big tech companies. So still, artificial intelligence and tech is continuing to be one of the dominant themes for investors. And I think there will be increased actually investments and capital flows into these companies. Now, of course, some of these have been quite expensive. So I think after the dust settles, when valuations are becoming more reasonable, I think money will keep just going in. Lastly, Trump policies. I guess needless to say, there's been a lot of credibility damage to U.S. policies as to, I mean, how reliable can different nations trust in any of the U.S. policies that Trump put out. And most importantly, I think there's a question mark as to the policy on U.S. dollar. And till today, it's still not very clear whether or not Trump wants to pursue much weaker U.S. dollar or will keep the U.S. dollar strong. I think that is one of the also longer term implications that we've learned in Q1. So given all this, what are the investment implications? Number one, as I mentioned before, bond is still the weakest link. And unless the economy really falls in a recession, I think bonds will, or long duration bonds, will still continue to underperform. And here we show the latest reading on the weekly economic index. So as you can see here, the latest reading is still 2.5. And I mean, if Trump concludes all the trade tariff negotiations within this quarter, then I think the impact to the economy is actually quite containable. And therefore, bonds could continue to underperform in terms of longer duration bonds. Second implication is, as I mentioned, the Trump sort of policy back and forth flip-flop actually puts a lot of question into US dollar. And in particular, if you look at the US dollar on a long-term valuation basis, it's actually very expensive. So this chart actually shows you US dollar versus a basket of other currencies in terms of its exchange rate. Now, you can see that the gray line is actually quite actually very, very elevated. And that means basically US dollar is expensive versus most of the other currencies. So when you look at a chart like this, I think the odds are that US dollar or that gray line is more likely to come down than to go up further. And indeed, over the last sort of, 20 years, 40 years or so, we've seen two major kind of US dollar cycles. So given like what's happening, I think a lot of the European and Japanese investors, or even Asian investors, would be thinking about their US dollar asset exposure and whether or not it makes sense to repatriate some of these back to their home countries. And if that happens, that would put pressure on the US dollar. And therefore, this is something that I think is kind of worth highlighting. Lastly, in terms of investment implications, so there's been a big kind of reset in US tech. Tech companies have actually corrected quite a bit. And a lot of that has to do with valuation reset. As we all know, as we've been talking about, number one, like the big tech companies in the US are quite expensive. Number two, they're very, very crowded. And I think the reason why we think that actually investments into AI, into tech will continue is because China has caught up. And if you look at this chart, basically on the left-hand side, you can see that there is 3 lines. So these are adoption curves in terms of how much AI is adopted in US versus China. So there's 2 lines for China. The darker purple line is the kind of old adoption curve. And in the middle, you can see there's an updated adoption curve after the DeepSeek moment. This is done by Goldman. And if you look at the gap between these lines, previously, what the common consensus was is that China is sort of 12 to 18 months behind US in terms of the AI technology. However, the latest estimates actually puts China not too far from the US, somewhere around perhaps like 3 to 6 months. So, and then also, China's biggest AI model developers are going to increase their capex by 38% this year. So if you are a US tech company, or if you are kind of the administration, you would, of course, still push forward in terms of AI investment. So I think there was a lot of concern about, oh, has the AI bubble burst? Like, is the sort of the whole kind of tech story gone? In fact, I think it was a valuation reset. It was a crowded trade unwind, but I think the fundamental story actually continues. And here is a chart that shows you valuation. And as you can see here, we have the S&P valuation, we have the tech sector valuation, and Max 7 valuation. All of them have actually come in quite a lot. And indeed, if you look at Max 7 itself, it's now back to kind of historically low valuation levels. Of course, the caveat is that this is a price to earnings ratio. So even though PE has come down, we would expect some earnings downgrade to continue. So that's why we think that over the next few weeks, when the companies report their first quarter results and give second quarter guidance, it would be a good time to sort of reset expectations. And by the end of this quarter, we'll see kind of how things settle. But in terms of valuation, a lot of that has corrected already. So that's quite a lot to think about. And I think every one of us are kind of thinking, how do we deal with it? And I think it's actually not that different from what we've always been talking about. Number one is, of course, to consider your risk and make sure you are in the right risk portfolios. And that's why we have the 12 different risk points for you to select, for you to be able to sleep at night, and most importantly, for you to be able to stay invested. Because things do correct from time to time, and but also things will recover. So market volatility is actually quite normal. However, the ability to stay invested, the ability to not get shaken out, is actually important. And that's why minding your risk is the number one thing to do. Also, I think the second thing that you can do or take advantage of is to think about these drawdowns as opportunities. right? Because I mean, the market just corrected 20% or 10%, and it's giving you actually much better entry point. So even though you may not be able to time the exact bottom of the market, doing DCA or doing kind of deposits during these turbulent periods typically results in pretty good returns over a longer time period. For example, if you think about next 6 months, 12 months, typically if you are able to kind of capture these market turmoils, you would enjoy actually better returns. And also, I mean, of course, don't think too much about timing the exact bottom, or don't worry about just day to day, because if you zoom out to a much longer time horizon, actually these day-to-day movements actually don't make a difference. The only difference is your time in the market. So whether or not you can stay invested for 3 years, 10 years, 20 years, 30 years, I mean, that's when you make the most return. Actually, if you look at Warren Buffett, Warren Buffett actually made the most return in terms of dollar basis in the last 10 years because of compounding, because he's been growing his wealth consistently. So the main message here is to stay invested, and of course, stay informed as well, right? To understand what's going on and not to panic. So here is a checklist that we've, I guess, prepared, and I think this is a checklist that could help you to guide what you do and how you think. So the first one, I think, feel free to take a screenshot or we can send it later. But the first one is think about whether you are diversified enough. Second is, does your risk tolerance match your portfolio? Can you sleep at night? Because I mean, a lot of things happening at night, right? If you can't sleep at night, it's a problem. Am I holding too much cash? And actually, that's a problem we have across Asia and across our client base as well. A lot of our clients actually have too much cash. And actually, I mean, these market sell provide very, very good opportunity to deploy cash. So make sure you go through this checklist. I think it's very, very helpful. And hopefully that guides you in terms of thinking about your allocations during these turbulent times. Lastly, what you can also do is, of course, to speak to us. And here's a QR code that you can scan. And that would take you to where you can sign up to be able to speak to our customer experience team and also our wealth advisors. So perhaps I'll stop here.
Yeah, thank you. Thank you, Stephanie. We received quite a few questions, and
Okay.
I've been trying to club them and kind of group them in a way that, consolidates a little bit of a conversation. So let me maybe start with the first one. So there are a few that are kind of on specific asset classes and a few on the economy. So let me start maybe from the broader one. There are two broader ones on the economy. The first one is, what can we expect if the tariff negotiations draw out past Q2?
Yeah, I think for sure there will be. I think given the complexity and given the sheer number of negotiations, I mean, there will be some negotiations that draw past Q2. I think, however, the most important ones to watch is, of course, the progress with China and the progress with key trading partners like Japan and Europe. I think I mean, if we still do not have a kind of de-escalation or definite kind of outcome by the end of Q2, I think that then, I mean, companies have a hard time planning for the next few months. And if you are a CEO of a company and you don't have any visibility into the second half, of course, you would start to kind of freeze hiring. You would also think about cutting costs, etc. So I think that's sort of when the impact will feed through to the real economy. However, I think that's not the base case. And I think the market also would react. And when the market reacts, I mean, that would also kind of push the Trump team to maybe make some, I guess, more reasonable requests. And hopefully, I mean, that helps to kind of alleviate the fear. So I don't think it's a linear thing. The market actually, it would trigger some market reaction. The market reaction actually prompts the administration to do certain things. And as we've seen, I mean, that's actually exactly what's been happening in the last 2 weeks, right? The Trump administration put out like these policies, the bond market didn't react positively, and that pushes them to react. So I think that would continue in the next 3 months.
Perfect. Talking again about the bond market, actually, given you were talking about it. So what will happen if Trump decides in some form to not honor T-bills or treasuries?
I think that would be
Armageddon questions.
exactly right. That would be disastrous. I cannot imagine why he would do so, because that would completely destroy U.S. credibility, and that means they won't be able to raise money again. And given the sheer amount of deficit that they're running, they have to raise money. So I can't imagine why they would do that. Indeed, what I expect the Treasury to start doing is actually to start buying back some of the bonds. So, and also if you look at the Fed has already slowed down its QT program, and I think the Fed will very, very soon end its QT program. So, if anything, whatever they do, they would be wanting to support the bond market instead of destroy the bond market.
Talking about bonds, let me go on some of the questions that are on specific asset classes. I'll start with bonds. So you had a slide, you were saying that bonds will, unless there is a recession, they will be underperforming. And so the question is, regarding bonds underperforming, should we be concerned investing in the low SRI portfolios, or are they allocated differently?
So the lower SRI portfolios, if you look at kind of the allocations themselves, actually they have a lot of allocations to ultra short dated treasuries. So when we talk about not favoring bonds, we talk about long duration. So these the ultra short duration is basically like your cash management, which generates about 4% yield in a very, very stable manner. So when you invest in a lower risk portfolios, actually these are very, very good stabilizers. Because I mean it doesn't suffer a lot of drawdowns. Basically on an annualized basis, you get 4% return. There's a bit of gold in these portfolios as well. But I mean if you invest in kind of low risk portfolios in a traditional asset manager, you may get a lot of kind of bond risk. However, that's not the case as statutory.
Thank you. On stocks, when do you expect the US stock market to hit bottom?
Okay, good question. But first of all,
take out your magic ball.
Yes, exactly. First of all, I think my prediction is as good as anybody. So I mean, my prediction actually does not play a role in how we manage the statutory portfolio. So that's number one, because we actually rely on a systematic model to help to guide our asset allocations. Secondly, I would say that in terms of the bottom in the U.S. market, I think if you think about kind of corrections, so we've had a 20% correction. If there's no recession, outside recessions, historically, 20% corrections would happen when there are recession fears. So for example, when I show what I show in 2018, what the market did in 2022, and these are sort of your 15 to 20% corrections, just because the market is concerned about growth, just because valuations are a bit rich, or just because I mean the policies were not pro equities. So I would think that unless things deteriorate from here, which is not a base case, then I mean we've seen actually the worst of volatility, and also probably I mean the worst in correction. Now, of course, can the market revisit a bottom? Yes, I think it can, depending on what Trump likes to say. But 20% correction is a very, very sizable correction already. The only episodes that like equities saw more than 20% corrections were, of course, during COVID and during the GFC, Great Financial Crisis. And then, of course, you can go back to history like Black Monday, etc. But all these are systemic risk, or either, of course, COVID was something that affected everybody. It was like everybody sort of didn't know what to do, and the world like definitely came to a standstill. Great financial crisis was the unwinding of a lot of leverage, and that was systemic risk. Today, we actually don't see a lot of these very, very sizable systemic risk in the economy. And that's why we don't think that there will be a crisis kind of brewing. Now, of course, if if Trump says no trade, we're not going to pay the US dollar, that's a different question, right?
Makes sense. Before I go ahead with the questions on specific asset class, there is a question that I actually want to take. Maybe I'll answer myself, which is how much cash on hand is too much? Maybe I'll take this one just to give you a bit of a pause and drink a glass of water. So the way we usually think and what we usually recommend to people is that you always need to have an emergency fund, and that's your cash on hand, and that should be 6 to 12 months of your monthly expenditure. So if you spend $5,000 a month, you should have anywhere between $30,000 and $60,000 of cash on hand, which hopefully you don't just put under the pillow, but rather you put in a money market funds, something like Stashaway Simple or Simple Plus to kind of keep some interest. Now, if you have excess cash, our recommendation is always to over time invest it in the market. And then depending on how important that cash is for you, is it 5% of your net worth or is 80% of your net worth, you want to be quicker or slower into investing in the market. Meaning if it's a lot of money for you, you might want to do it slowly over maybe a couple of years. And you can invest on a monthly basis over a couple of years, while if it's 5% of your money, you can be a bit faster. Now, what some people do is that you have a plan. Let's say you have a 18 months plan or a 24 months plan to get your cash invested, and then you use this correction. So if the market's corrects, you speed up a little bit, so that instead of doing, I'll just make up a number, $5,000 a month, maybe this month you do 2 or 3 times the $5,000 because the market has corrected, and that's a way to take advantage of the price going down. It is also perfectly fine to continue investing throughout the period. So in practice, how much cash on hand is, over time, you should have 6 to 12 months of your expenditures. Whatever excess cash, try to get it invested in your core portfolios and try to do it over time. You can decide to take advantage of the volatility there is right now to buy at a discount versus the usual prices. Stephanie, anything to add to this logic?
No, I think that perfectly captures it. I think again, the problem is having too much cash is that you lose out to inflation over time. So make sure, you don't have too much cash.
Good. So now, because the question keeps coming in, I don't think we're ever going to be able to do all of them, just because the number of questions coming in are faster than the way we answer it. So I'm going to club a few of them together. So there is a broad question of which markets do you think will be a good alternative to the US in the next 6 to 12 months? Would you recommend increasing global portfolio at the expense of the US? Now, don't start yet. There is a question about, will the market dominance be slowly shifting to other markets due to instability of fiscal policy in America? So kind of similar topic. And then there were more specific questions about what do you expect from Indian equities in the next 12 months and which Asian countries will be less impacted by tariffs. So I guess if we put them all together, the question is, how do we think about US versus international? And when you think about international, where you look for returns?
Yeah, I think if we think about equities from a first principles basis, you're looking for areas for growth. Now, of course, the reason why US equities have received so much attention in the last 2 years is because that's where you find growth, right? That's where you find technology companies benefiting from AI, benefit from investments. I think, as I mentioned before, I think this will still continue. So, that part I think is still very important for investors to be able to find growth. And I think over the past 3 or 4 months, what we've found or what the world has realized is that there are other alternatives. Like, for example, China AI is also developing very quickly, right? That's also where you can find growth. And Europe, particularly Germany, has announced a big fiscal stimulus program. And also, the companies would be able to benefit from that, and that would be a growth. India, I think, had a valuation reset, but the Indian growth story, we've written extensively about it. Structurally, that is also one of the fastest growth area in the world. So I think the difference now versus, let's say, 6 months ago is that, there are all these different options. And I think investors are also, I guess, have been very, very focused in the US, and there are rotations that are going on. So I think that actually opens up the door for for a better returns from a well-diversified portfolio rather than a portfolio just focused on the Max 7. And I think actually that's a great thing for markets, right? Because the Max 7 cannot be the only investment options forever. And I mean, now that there are like other pockets that we can look at.
Thank you. Staying on single asset classes, there is a question about gold. There's actually two questions. I'm going to ask you the second one later because I want to club it with a different topic. But there's the core one on gold is gold has trended up very strongly. Do you foresee that to continue, or you see that weakening with US dollar strengthening back?
Yeah, I mean, actually, as of I think last week or so, gold is actually up 30% year to date, which is of course a very, very fast move. And I think in the short run, it could be quite extended already. Because if you think about that 30%, analyze it, like multiply it by 3 or 4, I mean, that's 100% annualized return. And I mean, this is gold, right? We're not talking about NVIDIA. So it's been a very extraordinary run. And I think a lot of that is kind of panic buying into US dollar alternatives. So I think in the very, very short term, I wouldn't be surprised to see some correction. However, if you go back to our FAT framework, FAT, one of the long-term investment implications of fiscal dominance is that all these governments will need to perhaps issue more debt. And investors will be looking for alternatives to sovereign government, I guess, debt and also currencies. And if you think about gold, it's actually basically a hedge versus the significantly increased fiscal spending and fiscal deficits that governments will incur. So I think, I mean, it is actually a structural kind of long for us in a portfolio. However, of course, in the short term, it may correct a bit.
Thank you. So as mentioned, there was a second question about gold that actually links to a different topic. So I want to bring it to a different topic. The topic is more about how StashAway changes asset allocation through ERA. So let me maybe read the two questions. One is, how does the ERA framework change asset allocation for a specific portfolio if ERA indicates a regime change to a recession? And connected to this, it says, and if it's meaningful to switch to a lower SRI portfolio looking at such a fluid condition with the Trump administration. The other connected question was, given the outsized performance of gold, will there be a rebalancing in terms of weights in the portfolios? So maybe we should explain also reoptimization versus rebalancing. And again, maybe take it broad. I'm happy to take part of it if you at a certain point you want to rest a bit.
Okay, maybe I'll try to answer, and Michele, feel free to supplement. So I think first question is if there's a regime change to a recession, how would ERA change its allocation? So I think when a regime change happens, our system would actually run a optimization kind of I guess analysis based on the expected returns and also expected risk of the different asset classes at the time. So, but I mean, I can't speak to specifics, but I think broadly speaking, typically what happens is in a recession, ERA would actually increase its allocation to defensive assets, and defensive assets would include bond and gold and cash. And on a very broad level, it will decrease its allocation to risky assets, meaning equities and also some of the riskier bonds like high yield bonds or emerging market bonds. So that's on a very, very top level. The second question is with regards to gold. Given the recent run up, actually, StashAway portfolios are rebalanced on a regular basis, meaning that apart from the reoptimization, which is triggered by the regime change, actually your StashAway portfolio is rebalanced on a regular basis to make sure that the allocations are actually sticking to the initial allocations. So what I mean by that is, for example, gold has run a lot. So right now, gold's allocation is above our initial target allocation. What rebalancing does is that it will sell some gold to bring it back down to our target allocation. So from this sense, you can see, I guess you can sort of think about it as selling when things rally and buying when things correct. So I mean, that is the natural kind of rebalancing algorithm that we have for all our StashAway managed portfolios. And then I think the last question is about should you move to a lower SRI if there's a recession? I think the choice of the SRI, I mean, really just depends on two things. Number one is your time horizon for investment, and number two is your risk appetite. Why? Because let's say if you have a longer time horizon, you can you can sit through a lot of these corrections and let your portfolio return, let your portfolio grow over time. So you can afford to actually take higher risk. Versus if you have a very short time horizon, you can't give the portfolio to recover, and therefore the longer your time horizon, let's say if you are saving for retirement and you don't retire until like 30 years later, yeah, by all means, you can invest in high risk. The second criteria is actually your own risk appetite. As I mentioned, can you actually sleep at night, right? The reason why we have all these SRI is because we want to make it easy for you to be able to quantify what kind of risk you can take. So, for example, SRI 36 means that there is only a 1% chance that your portfolio will see a drawdown more than 36%, right? Even in the worst case scenario. And for the lowest risk, let's say SRI 10, that drawdown number is typically is 10%. So of course, having a drawdown of 10% is very different from having a drawdown of 36%. And you have to ask yourself, which one am I comfortable with? So those are the two only criteria that you should think about when you select your SRI. Your market view should not affect how you think about SRI because that is managed by ERA. Right? We actually already optimize your portfolio according to the market regime and the prevailing economic conditions. So you don't have to worry about it. So I mean that would be my advice.
Thank you, Stephanie. Look, there are still quite a few questions that I don't think we're going to be able to go through all of them. Maybe I'll take one more. If I understand correctly, the riskiest portfolio, the SRI 36, has lost around 2% year to date, while the S&P 500 lost more than 10%. How is that possible?
Good question. And I think if we go back to one of the slides, maybe too small. So if you look here, on the right-hand side, we show actually the breakdown of the SRI 36% portfolio. So here you can see on the bottom, yes, I mean, the S&P and technology stocks did detract from SRI 36% return. However, on the top, we also have gold. We also have FTSE All-World ex-US ETF. So actually, even though US equity had a pullback in the first quarter, actually ex-US equity had a good run. Also, we have some sector tilts that helped us in the US. For example, healthcare, consumer staples, energy, Japan. I mean, all these actually helped us in terms of portfolio returns. But I would say the biggest contribution is gold, followed by our non-US equity exposure.
Perfect. Look, Stephanie, thank you so much for also staying here for another 20 minutes asking questions. And thanks to all the people that joined tonight. And actually, most of you are still here. So thanks a lot for staying on. Thanks for our colleagues in the background that have actually been answering some of the questions in writing and have been helping. And I wish everyone a fantastic night. Thanks a lot.
Thank you so much, everyone.
Bye-bye.
Bye.